we give way too much credit, both against and for a president, when it's really about corporate profits. The market works on its own. Policies do matter.
Sure they do.
A lot of times policies come into play years later.
All thoughts and opinions shared in this recording belong to the participants. This podcast is meant to inform and educate and should not be seen as solicitation or endorsement for business.
Welcome to the Market Moment. This is Matt Walters, and I'm joined by John Martfeld and Lee Mackey.
Good morning.
And a lot going on. We've got we are T-minus 13 days or so.
2 weeks from
14?
2 weeks from today.
Oh yeah, 2 weeks from today. That would have been a much better way to say that. But got election coming up right around the corner, so get out and vote. Early voting started here in Arkansas, so I know some people in the office went and voted yesterday. So
I'm going to go today.
Let's go. All right.
My wife got the little button.
Yeah, wear it with pride.
Yeah.
It is a privilege to be able to go out and vote. So never want to take that for granted. So today we're going to talk about, on the topic of elections, what has the market done historically leading up to the election? So not a long term. This is kind of looking at short-term market trends and volatility, like the month or so before and the month or so after. So I ran some data and we'll look at some things. I know you guys have some stuff on. But, you know, really looking at like October 1st through the election and then from the election through the end of the year. That's kind of how I looked at it. What has the market done historically? What is it doing this year? And are there any kind of, takeaways, things that we can learn from that? Probably not, because that's a really short period of time, but
Right.
It's still interesting to talk about. So anything before we jump in, any initial thoughts on this, or do you guys want me to?
Matt,
Okay.
Lead us.
Okay,
Lead us, Matt.
Started off. So this is data from Y charts that I was able to pull down. So went back to the 92 election. Okay, so I didn't go real far back because I did this like 45 minutes ago. So did the 92 through 2020 election. And when you look at October 1st through election day and election day through the end of the year, okay, the average return the 4 to 5 weeks before the election is minus 1.37. Okay, now there's 4 of those 8 election years where the market was negative, 4 of them where it was positive. And then after the election, through the end of the year, which you're kind of catching that Santa Claus rally, right?
Yeah.
Typically
Yeah.
a good time for the year. The average return is 2.29%. So this is on the S&P 500 total return. And there were only 2 negative years after the election through the end of the year. Those 2 negative years, I'll give you one guess. 2 guesses, I guess, since there's 2 years.
2008
Okay.
That was safe.
Yeah.
and 2020, maybe?
I'm going to go with 16.
2000 and 2008. So
2000.
the last 2
Yeah.
big bear markets,
yeah,
right?
yeah.
So we were in the thick of that. 2008, the market was down 19.5% from October 1 through the election day. So, we were in the thick of it then.
We had banks closing and Lehman Brothers closing, I think, in that October, yeah.
Yeah. What's really interesting is, so some takeaways here. Well, I don't know if they're real takeaways, but just some interesting data points. When the market is positive from October 1st through election day, every time of these 8 instances, it was positive through year end after the election. The market currently from October 1st through to yesterday is up. Well, I can't quote it because it went away, but it's up like 2.6%. Okay, so it's positive. So it's just,
It's positive. We only have a few more trading days left.
for what
Today-
it's worth, right? That's
Yeah.
the last 8 presidential years. When it's been positive October 1st through the election, it's finished the year positive from the election.
Are you looking at the S&P?
S&P 500 total return. Yep. There were years, obviously, right? We had Clinton, Bush, Obama, Trump, Biden. There were years the incumbent party won. There were years that the party flipped,
Right.
the White House
Right.
flipped, right? No real major trends there. That's just kind of what the market has done over the, last couple decades in election years. Thoughts? Any other data?
One little data point here that I thought was interesting. Small cap stocks tend to outperform after an election through the end of the year historically, outperforming the large cap stocks by a pretty good margin if you look at all the history going back to 1928, which I thought that was just an interesting little nugget.
Yeah.
We like small cap stocks. They have not, maybe separated themselves like maybe I thought they would so far. We didn't have small cap summer hashtag, right? Isn't that what we're supposed to have? Hashtag
Yeah.
small cap summer. So maybe we'll have hashtag small cap winter. But anyway, I just thought that was an interesting little nugget. And the other thing I thought was interesting when doing all this research, it doesn't matter who gets elected necessarily. Like a lot of people are worried that if a Democrat gets elected or if a Republican's elected, depending on what side they're on, that things are just going to go south fast, right? I was just listening to a report I have my Fox Business on in my office, and I was just listening to a report about the likelihood that there's a sweep one way or the other, right? Republican sweep or Democratic sweep of House, Senate, and White House. If that were to happen, yes, there could be some definite market movement, because that some of the policies that want to get, they're going to get through, most likely, right? Whatever the policies are, good or bad. But the chances of that are very slim, even in this election, that we have a sweep one way or the other. And I think that's a big part of, we give way too much credit to the president, whoever is elected president. If they have a divided Congress, most of the stuff that we fear they're going to put through, if we fear it, doesn't get through anyway.
Yeah.
Right. So it's not necessarily as big of a deal as we make it out to be as Americans.
I mean, it's easy to think I like this person, I like this policy, market goes up. And it's just not that simple.
It's just not that simple.
And I think as a general rule, I mean, we're talking about the month leading up to the election. I mean, markets don't like uncertainty. We've talked about that all the time. Yeah. We're not seeing a whole lot of it right now, but, if people are nervous, they'll just park, get on the sidelines. And then on November 6th, no matter who wins, they feel like at least now that uncertainty, that unknown has been taken off. So they'll get back in. So, I mean,
and that's a horrible strategy, just in my
absolutely.
I mean,
no, it is.
There's a lot of people who want to do that, and there's a lot of people that makes them feel better. And depending on the situation, it may not be a make or break decision for you, but it's still a bad strategy.
It is a bad strategy, and I don't think that was as much. My comment was as much about which party, as much as it was just the uncertainty of not knowing.
Sure.
Well, and going to your point, I think if you look back at that data of the half the time it's up, half the time it's not, the years that it's up, is it because we have more certainty who is going to win the election by October? A lot of times by October, there's, in history, a president, go back to Reagan, for example. Reagan, not against Carter, but against Mondale, was going to win. Like that was known. Obama, and when he ran for re-election, was going to win, right? So maybe those uncertainty is taken out and the market doesn't get as scared.
And I
about
think
that.
we even saw that, this election cycle up until 6 weeks ago when Biden dropped out and Harris was inserted.
Yeah.
I think the markets, everything was pointing to this is going to be
Trump.
a Republican win.
And so much of the data, historical data, it's just a timing thing, right?
Sure.
You look at when Bush got in office, right?
Right.
He inherited the .com bubble, and then 9/11 quickly happened thereafter, right? You look at Obama. Obama inherited the great financial crisis, right? In his first presidential term, that first year, we're in the thick of that. Neither of those were those people's fault, right? I mean, they had absolutely nothing to do with it. So trying to make decisions or make even specific references to what the market has done based on who's been in office, you have to zoom out and be like, okay, what was going on, during that year and during that time, because they likely had absolutely nothing to do with that.
And they have a lot of times absolutely nothing to do with the rebound.
Sure.
With the recovery. You go back to 2009, the market had fallen from 14,200 on the Dow to 6,400 on the Dow by March 7th. Well, Obama had been in office for just a little while, right? Just a month, a little over a month. And the market has hit its 54% down number. Well, at some point, the market's oversold. It was clearly oversold. It's going to come back. Now, I'm not taking anything away or put anything on. I'm just saying we give way too much credit, both against and for a president, when it's really about corporate profits. The market works on its own. Policies do matter.
Sure they do.
A lot of times policies come into play years later. Even if you have a policy today.
And that's about who's controlling Congress. Just as, we always talk about the White House, right? But Trump could win or Kamala could win, but depending on who wins Congress,
No
is
doubt.
going to have a huge say in what actually gets done in terms of their agenda.
Yeah, these
And-
crazy tax.
Yeah.
The difference in tax policies is very big between these two candidates, and it does scare people. Like if one gets over the other, right? But even if it doesn't matter who gets elected, they still have to get those tax policies through. It's not like they immediately their tax policies go into play.
Right.
Most likely, not even close to it. To be,
Sure.
And so, anyway, yeah, we put a lot of stuff into it. It goes back to again corporate profits, and I'm watching these artificial intelligence companies coming out, and I think Taiwan Semiconductor, the pressure of the sales are so high in there. Nvidia's now hit an all-time high again yesterday. The market seems to be based on our technology companies. I mean, it just seems like we're skipping right on through that John's scared times, and we're moving on. But again, it has nothing to do with the election, right? I mean, this stuff is important out there in this universe. The artificial intelligence stuff has nothing to do with who is in the White House or who gets elected.
Right. Yeah. I think the clear takeaway is you have to separate, your investment decisions and the investing landscape and from, who you want to be in the White House, how you're going to vote, and the political. It doesn't mean that the political arena and who's winning and who's losing all absolutely matters, right? But you don't want to get those two things too commingled, because that's where it's already hard. It's already hard enough to make good investment decisions and to stay rational,
right,
and to stay level-headed, decade after decade, year after year. Like, it is incredibly difficult, and then you want to make things that much harder. Like, throw in all your political opinions and act like that has a direct control, especially in the short term. It just makes it that much more difficult. So as we always say, have a plan, stick to that plan, make modest adjustments. I've been talking to a lot of clients lately of like, hey, we want to make some modest adjustments. Like, that's fine. Let's tweak. Let's keep ourselves, though, from making these big, in and out, all in one way or the other type of decisions. And I almost can promise you in 1, 3, 5 years, we look back and be like, we're really glad we didn't make a knee-jerk reaction one way or the other.
No doubt. And I always say that, I know it's a broken record, we do what we call a retirement analyzer here, for our clients, where we map out their whole retirement plan all the way to age 100 and what their legacy plan. We cover all that stuff. And if it comes out that you only need to make 5% on your assets to achieve all the goals you're trying to achieve, you don't have to be in the breadth of you don't have to take all the risk of the market anyway. Right? I mean,
Sure.
And it's our job to kind of help them, guide them, and allocate properly towards. Yeah, you can obviously take a little more risk than what 5% needs. But my point is, know that number, and then it doesn't matter what the market does. You can have an allocation that doesn't take if the market goes down 54% like it did in 2008, that doesn't mean you go down 54% if you're properly.
Right.
If you have a good team working with you and you understand your plan.
Right.
And the last thing I'll say on this, on the election, God is in control, right?
Amen.
And it doesn't matter what happens; it's all going to be good.
I wasn't laughing at your God in control comment. I was laughing at you.
My coughing.
Yeah, your perpetual clearing of the throat.
Yeah, I know.
For the entire podcast.
Sorry about that.
Okay.
I thought you were laughing at him saying, and finally, for the 5th time.
Yeah. John is always a good time. So
We need to take a commercial break.
Yeah.
Okay. So on that note, but good way to end it. God is in control. Amen, brother. So, all right. Bulls and bears. So bear markets, bull markets. This may be short, but we haven't talked about this beforehand. But when do they begin? When do they end? So a lot of this is, I think, what I meant by this when I put this in the docket was, depending on when you start and stop a bull market or a bear market has a lot to, it can make the data look very different, right? So if you look at, did the last bull market begin? Sorry, I'm struggling here. At the end of the, market sell-off in 2009, or did the next bull market start when the market got back to where it was before it started to sell off, right? So depending on how you're measuring, are you measuring it from trough to peak, or from, the last high when the market's recovered to the peak? And I butchered that, but I know what you know what I mean.
I think it's important. Let's ask it a different way. When did the bull market end, or the bear market end? I guess you could say.
Well, I think
from if you're defining a bull market, a 20% run.
Yeah, it's a 20%
from the low,
or more from its low.
From the low.
Yeah.
Then, I mean, and again, you don't know when a bull market starts until you look backwards.
Sure.
You know. Sure. But then the question is,
well,
when did it end?
Okay, so let's define it. So when in your opinion, when does a bull market end?
When does a bull market end? Again, you're looking backwards in time.
Yeah.
So it's going to be. I know the bull market starts when
I'm
it's.
not
20%
asking for
up.
a specific historical date,
No,
but just like.
I mean, that's a good question.
It's really hard. Maybe we're not intelligent enough. To
No,
answer this question.
No. I would say like I'm reading this like this is the widely held bull market, bear market definitions, right?
Okay.
A bull market is a period of time during which the stock market, typically represented by the S&P 500 index, gains 20% or more from its last long-term low point. So,
Okay.
if you go over here, hold on one second. I'll give you the exact definition of.
So a bull
bear
market stops when the market has sold off 20% from a recent high.
That would be how I would define
That's
it.
how you would define it. Okay.
A bear market is defined by a prolonged drop in investment prices. Generally, a bear market happens when a broad market index falls by 20% or more from its recent high. So it's the same.
So if we go up 20, we're in a bull market. If the market then drops 10,
That bull market hasn't stopped.
correct.
That's just
because
a
the
correction.
bear market.
That's just a mid-cycle correction.
That's correct.
Exactly.
Okay. So I don't know any more than I knew 3 minutes ago. But that's
Nor does anybody watching.
That's when a bull market. That's when a bull market ends.
That's my opinion.
Okay, when does the bear market end? So does the bear market end? So the bear market technically begins when the market is down 20%
from a high.
From a high. Does the bear market end at the trough? Does it end when the market's gotten back up to
20% higher.
20%? Yeah.
Well,
I would say at the trough.
I'd say at the trough
then that's-
too, but you don't know that.
But then that's
until-
contradictory.
Okay, quit
about,
with the disclosures. Just give me your opinion.
No, I'd say at the bear market, we stamp the bear market over when it's 20% above, right? So maybe that's when you could say the bear market ended. Because if it gets to 19%, if it goes back up 19% and then craters back down, then that you're still in the bear market.
So the
right?
reason this matters is when you're looking at like the length of
Yeah,
time in
yeah.
a cycle, right? If you, depending on when you started, the bull market coming out of the great financial crisis, that was either in 2009 or like the end of 12, beginning of 13.
Yeah.
So there's almost like there's a 3 to 4 year difference between how you define that bull market beginning, which kind of matters just historically looking at these cycles and the returns in the market. And so,
I can tell you this by looking at like historical data, and this is from Forbes. So if you think Forbes, they're just using theirs. They're giving all of the bear markets and bull markets, and they have the bull market starting in March of 2009, which would have been at the bottom, and they have that ending in February 2020 when we hit that COVID correction of over 20%. Mm-hmm. So that's that, and that's Forbes. But it does say in this definition, it says that there are other measures.
So that bear market in February of 2020 lasted 3 weeks.
Tiny amount of time.
I mean,
sure. Yeah, and that's where I don't really know the point we're trying to make here, but
it's interesting when you start diving
well,
into
and I
it.
also think there's this feeling that like the market's just been this straight line up since the great financial crisis.
Yeah.
Right? And it hasn't been.
No.
Right?
No, we've actually had a stop in
We've
the
had
bull market.
We've had two legitimate bear markets, with COVID being a very short, rapid one, right?
Right.
And then 2022. The market was from December 28th of 21. I think that's the exact date. Through December of 23, right? The market was flat.
Yeah.
It was down over 20%, 30%, and then it took a full year to recover. And so there was a 2-year period where if you owned SPY, your return was zero.
Yeah.
Right? And so this idea that the market's just been this straight up and to the right for the last 15, 16 years.
Yeah.
it's just not true. And I think it's good to remind ourselves of that. It's like we've had volatility. We've had bear markets. We've had a lot of corrections over the last 15, 20. Have returns been good? Yes, absolutely. They've been historically good, but not without some interruptions along the way.
I almost don't even, I mean, this is just me personally. I almost don't even count 2020 because it was so quick.
And it was it's a unique situation.
But some clients, I mean, they were getting, by the time they were starting to get their March statements, it was over.
Yeah, no doubt.
I mean, by the first or second week of March, man, the market was back off to the races. And so, yes, it was a 32, 33% drawdown, but man, it was fast.
Yeah.
Yeah, I would say that I hear what you're saying. The nice thing about what you're trying to, or what we're trying to get across here, is that if any time in that moment just go back to 2007, when the Dow was at, and I'm using the Dow, but the Dow was at 14,200, and the amount of mistakes made from 2007 to 2024, when we're at all-time highs, 43,000 on the Dow. So regardless that the Dow went from 14,200 all the way down to 6,400, it went all the way up to 30,000, went back down to 19,000, and now we're at 43,000. And the point is that, in that small amount of time, 16, 17 years from 07 to now, if you'd just been in the market, you are winning. You're winning. If you let any of the emotion, any of the market turns, any of the language, any of the stuff the big terms, bear market, bull market, any of that stuff drive your decision making, you missed out on a massive opportunity in the market.
Sure.
By letting emotion control and letting all these little things. And I think when you watch the news today, we have social media and all this stuff, and everybody's got a new kind of trick to make money in the market, or if you get lost in, depending on what channel you watch or what show it is, like the politics is going to just ruin the country one way or the other. And I think people can get very bad information with all the information that is now available to us, right? Instead of just staying the course and understanding that our U.S. economy and our U.S. markets are the best in the world. And we go through all these data points just to say we've gone from all these bear and bull markets and all these little things. We've gone from 6,400 in March of 2009 to 43,000 today. It's unbelievable, right?
I heard I heard an interesting fact back when I was working at Morgan Stanley, and I'm going to get these numbers off a little bit, but it proves our point. So often, people don't want to buy a stock or the market when it's at a high. Okay, it's like, oh, it just hit an all-time high. I don't want to buy it. I heard a speaker say several years ago that when a stock hits an all-time high, on average, it will hit, I think the number was 72. It will hit 72 more all-time highs before it begins to go down.
Well, so much of the market is strength and momentum.
Sure,
right?
absolutely.
And so very rarely does a stock hit or does the market hit an all-time high and then immediately roll over?
Yeah.
It rarely, if ever, happens, right? And so,
I just found that as an interesting, another interesting way to say stay invested. Yeah. Anyway,
so we've been all over the place a little bit here on this one, but bull markets, bear markets, when do they end? When do they begin? The 90s the 80s and 90s were a phenomenal time in the market, right? There's
sure,
not without some hiccups, right? You had the 87 crash, you had some things along the way, but there was a phenomenal time in the market. And then from 2000 to 2010, the market did 0% annually.
They call it
for 10 years. The market did 0%.
They call it the lost decade.
Yes.
Yeah.
And so coming out of that, since 2010, you went a decade without seeing any real growth in the S&P 500, and so don't let a decade or two of really good performance with some bumps along the way scare you.
No doubt.
Like, if you could make a great case that we were due for it. We went for an entire decade with absolutely no growth or returns in the S&P 500, and so we were due for some of it. And the companies have gotten better. profit margins have gone up with technology companies, and so it's just a different market today than it used to be. So on that note, as we're looking forward, one of the big things that came out the other day came out on October 18th, the Goldman Sachs report. So a lot of people talking about this, kind of Goldman Sachs projections over the next 10 years with the market. So I'll highlight a few things and we'll kind of wrap up with this. In their summary of the next 10 years, they think the S&P 500 will deliver a nominal total return of 3% annually. Annualized nominal returns between -1% and +7% represents a range of likely outcomes around their baseline forecast and reflects the uncertainty inherent in forecasting the future. They expect bonds. Where is this at? 3% annualized equity return forecast combined with current 10-year U.S. Treasury yield of 4% and 10-year break-even inflation of 2.2 suggests the S&P 500 has roughly a 72% probability of trailing bonds and a 33% likelihood of lagging inflation through 2034, so over the next decade. They also believe that the S&P 500 cap-weighted will underperform the S&P 500 equal weight. Okay. And they said the equal weight could outperform the cap weight by an annualized return of 2 to 8% annually over the next decade. So some interesting points there. I think that's basically they're saying, and correct me if you guys interpret this different, but with the disparity between the cap weighted expected returns and the equal weight, they essentially think the mega cap technology companies, communication services companies will underperform the broader market over the next 10 years.
No, I agree, but it sounds like a pretty bearish report, right? I mean,
well,
I
think
if the S&P may not beat inflation and it will underperform bonds according to, like the likelihood it'll underperform bonds. I mean, that sounds obviously a little bearish, right? Because the last 20 years, markets destroyed the bond market.
They think growth will be hard to come by in the cap-weighted index. Now, there was a huge difference between their expected returns between the cap-weighted and the equal-weighted.
Yeah.
So I think, again, going to reiterate, it doesn't mean that there won't be a lot of stocks in the market working really well.
Sure.
Which would bode well for active management, right? If this were
100%,
to prove to be true, passive will do much worse over the coming decade than it has in the last decade.
Well, and 60-40, is back.
It's going to work.
It works.
Yeah.
It works again.
100%.
Yeah, it has been lost for 20 years. It's back.
Yep. So some interesting takeaways for sure. You can go find that online. It's the Goldman Sachs Global Strategy paper that just came out on October 18th.
I think we can link it.
Yeah, we can post the link in the show notes.
It's interesting stuff. And I, of course, Goldman Sachs is a well-known company. I will tell you guys, when I was back in 2008, and I went to a conference in the summer of 2008, and the head speaker was the leader of a company that's no longer in business now, and they were a big, huge firm on Wall Street. And I just remember the guy saying that 2008 was it was like early part of the downturn. He was like, this is nothing. The banks aren't in trouble. There's no problems at all. And this is the chief analyst from a huge firm. Sure. And so I always, when I see these things, these reports, like trying to predict 10 years out,
right?
It's just a prediction.
Yeah.
It's if you go back to the beginning of the year and you look at what people thought that was going to happen this year in the S&P, guess what? We've blown through all of those predictions, right? We're much higher than even the highest of predictors.
These kind of forecasts are interesting, but worthless all at the same time.
They're kind of worthless.
I mean, they really are.
But it's good information, right? It's unbelievable information, and all of it is smart. And
some of it is aligned with kind of what our thinking has been in terms of utilizing more and more fixed income in portfolios and shit. Like, that's something
100%.
We've been doing over the last year or two.
Yep.
This kind of confirms that. So you don't want to necessarily change anything based on this report, but it can be validation on maybe things that you're already thinking one way or the other.
I love the way we are doing it at this office, right? And our tactical approach.
Yeah.
And I do think that, like, to your point, Lee, the 60-40 model is the model is back in play.
Sure.
And again,
which is good.
Just to wrap it up, I don't necessarily think it's a bear market.
No, yeah, it may not be bear, but
I think
not
it's
good.
a much more spread out.
There's going to be a bear market along the way. It's just going to be a lower growth, annualized returns.
Yeah.
And hey, and if that's what if that's what we think is bad, is 3 to 5% returns, I'll take them.
Yeah. Well, I was talking about this with Lee yesterday. We've talked about inflation, right? And how bad inflation has been over the last couple of years. Yeah. But if you're a believer in reversion to the mean, right? We had 15 years of historically low inflation
100%.
for a long time.
Yep.
It was like 1.5% annualized inflation rate. The historical average over the last 100 years is 3.2. So you just have to look at, like, we're going to have a period of higher inflation just so we get back to the mean. Same thing with market returns. The last 15 years.
Same thing with interest rates.
Have been good. The same thing have been really good. So you're to expect a period of just lower returns, I think it's reasonable. And you have to be level-headed enough and reasonable enough to know, like, that's okay.
Yeah.
So the decade that we had that was very little growth, zero growth, we just talked about.
Yeah.
People made money in that time frame.
Sure. 100%.
And Lee and I, you were just in diapers in this decade, but Lee and I were in the middle of our career.
Young, but
you were playing basketball for Harding, or
yeah,
at that time. So, but we were, our clients, we were able to find a way to make money even in a lag period of market. Sure. And you don't even know it's a lag period of market until you look back, if that makes sense. But anyway.
All right. Well, good conversation. Hopefully that made more sense to you guys than it did to me. But as always, we appreciate you watching and listening. Give us a comment, like, subscribe. We're putting out a lot of content with our No Dumb Questions, our data brief, the podcast. So check out everything we're putting out there. We appreciate you guys, and we'll see you next week.
The hosts of the Market Moment podcast are employees of Mach 1 Financial Group, LLC. Mach 1 is a registered investment advisor located in Rogers, Arkansas. Mach 1 may only transact business in those states in which the firm maintains a notice filing or has qualified for an exemption or exclusion from registration. A copy of Mach 1's current written disclosure brochure is available through the SEC website and available at disclosures.mach1fg.com. Thank you for listening to the Market Moment podcast.